let's find out how this is all being judged by markets. Of course, that's what matters to us here right now. Pete McGuire is joining us from XM. Peter, really good to see you there. Good morning to you. Look, this is a very laden week in terms of central bank action as well. Let's start with the FOMC. I raised it earlier. It's hard to see where the risk lies around this because, of course, we're expecting that 25 basis point cut. So when you look at what could potentially come, what could set a cat amongst the pigeons?
Well, good morning, Nadine. Good morning, Andrew. That's such a broad question, Nadine, and in the sense what we've seen last week, we saw that number hit 7.9% for inflation, 40-year high. So that's certainly an impact to the Fed. The second part of it, of course, is rising fuel costs, and I paid $2.44 for a litre at Randwick the other day. So that really impacts the consumer globally. You're talking about that US dollar index and very, very strong numbers approaching 100. And what we saw last week was a continued sell-off as far as global equities and energy prices ranging from 110 to 140, now back at 110. So it's an incredibly volatile 5 days, and this week may mirror image what we saw last week.
Yeah, so how is this going to play out, particularly when we talk about those fuel prices, Pete, that essentially act as a tax on the consumer, therefore they're likely to curtail their spending elsewhere. How's the Fed going to contemplate what effect that's going to have on the economy at this point, and therefore what it's likely to do with rates?
Well, and I think what the first point we've got to look at, Andrew, is if that 25 basis points is baked in, and let's assume that it does materialise in the next matter of a week, and all of a sudden that's where we go to the races. How many rate rises do we see? There was speculation we could see 7 for the year, then it's back to 3 now, where they're saying they may roll it out to 5 or 6. It's a very fluid situation. Also, the other side, of course, is weaker than expected growth expectations in that third quarter, which could lead to a stagflationary environment by mid-Q3. That's the hum that I'm hearing on the street. So that really creates a dilemma for any central bankers. And if you just have a couple of rate rises, then I think that could take a little bit of the good feel out of some of those markets in the sense of equity markets, and create again, a delight for all currency traders.
Now, we saw U.S. consumer sentiment, according to the University of Michigan, down already as inflation expectations continue to rise. In fact, hitting the highest level since 1981. In this environment, again, we get some consumer expectations tonight, but it's really interesting to see the buying of the US dollar in terms of safe haven flows as well. Absolutely. So talk to us about the cross currents in terms of currencies, because of course we've got the US dollar getting support potentially by the war, but also resistance coming through from the FOMC.
Absolutely, Nadine. We're sitting at 99.13, so it's been an electric 9 weeks since the start of the year, since Christmas. It's just been one-way traffic for that US dollar index. We're now at 109.80 approximately for the euro. We're at a 117.35 handle for Japanese yen. Pound's been crunched. Aussie dollar's been whipsawing, but it hasn't seen the sort of movement that we've seen as far as yen and some of those other currencies. So really creating, I think, a lot of turbulence naturally for the market. Gold market really got hammered down. We were running at about a 2060 handle. We're now at about 1985. So as the US dollar continues to have that upward beat, I wouldn't be surprised to take triple figures out this week, 100 US dollar index. So that again creates volatility and the baked in, I think, mindset as far as Fed moving forward. More rate rises. 101 could be the new number that we look at by the end of the month, Nadine.
And Pete, not just the Fed meeting this week, we do have the Bank of England, also the Bank of Japan. As far as the BOE is concerned, tell us how this has been reflected in the pound there at the moment, with the expectation another 25 basis point hike as that economy runs hot.
Absolutely, Andrew. We're running at about a 1.30 for the pound, and I wouldn't be surprised to take a little bit further out of that. It's had a very wild ride over the last couple of weeks, down from that 134, 135 handle. Now we could see, a 128, 129. So really it demonstrates the volatility across with interest rate expectations from central bankers, talking about the US dollar strength with the war crisis and the, baked in 25 basis point from Powell, all of that going in, I think is going to add a little bit more firepower to dollar, weaker pound, and the Bank of England will, as you said, raise at 25 basis points. Let's see what they do by the end of this quarter. You could see, the end of the next quarter, you could see a couple more on their radar.
So all we get from our local central bank this week are the meeting minutes from the previous meeting. Last week was pretty news-driven in terms of Guy Debelle stepping down as assistant governor. But when it comes to the Australian dollar, same sort of cross currents as the US dollar, correct? War on one hand, that should detract from risk currencies. But also we've got continued strength in commodity prices. Yes, they came off on Friday, but still very elevated. The Aussie dollar is very live this week, wouldn't you think? With the jobs report on Thursday as well?
Absolutely, Nadine. I mean, it's been a whipsaw of a market. It was only a couple of weeks ago when we were talking it was under 70, and then all of a sudden it bounced to that 74 ride. We're now just under 73. So it's been a wild ride for any trader that's been, looking at that Aussie cross against the Japanese yen or naturally against the US dollar. So it's been very, very... it's been a good market to trade, as simple as that. It's just been extraordinary. So plenty of movement. And what happens now, I think, will be a further softness. Those commodity prices, have a look what happened to nickel, have a look where we are as far as food prices. Copper's back up at 10,100. So a lot of those base metals have had big rallies to the upside, and naturally also a lot of the food. So inflation is hitting from a commodity side, and everyone's being hurt at the hip pocket.
And Pete, just before we go, how are you looking at gold at the moment? It has actually come off again. Are you seeing, what sort of support are you seeing for gold at this point, given the macro picture?
I think, Andrew, I wouldn't be surprised to see resistance around that, or support, I should say, at around about 1960. And I wouldn't be, again, surprised to see it bounce like we did last week. The uncertainty, all of those impacts running across the gold market. A big support from retail traders and from physical gold purchasers. So I think the time to be in gold is now. And if you're looking at buying it, it's probably cheap today compared to what it could be in the months to come.